Hello, everyone. Welcome back to part two of our discussion of rental activities and other things in chapter 8. So, this is the one that probably will give us the most trouble. And this is a situation where the rental property is used for more than 14 days. So, it doesn't fit the uh, minimum amount of personal use and rented for 15 days or more. So it doesn't fit uh, the situation where you've only rented it for a couple of days. And so this, all income expenses reported on the Schedule E, but you have to allocate between personal rental, and the expenses are never deductible for more than what you got as income. So it's always in these cases where this personal use, this is considered a personal home, and therefore in this situation there's no loss. You cannot have more expenses than income, and that's important to understand. On the Schedule E, you're going to report if there is more expenses, you're going to reduce your expenses so that it reports zero income. And the expense that usually we reduced is your depreciation. But we'll see how that might play out a little bit later. So example, rented our lake house for 90 days and she used it for 50 days. Okay, so it's not too small of amount of days for rental to get the free income, and it is not uh, too little personal to be primarily rental. So this is the mix, and this is where an awful lot of things fall, especially if you're talking about like an Airbnb type of scenario. So a little review. Rented our house at the lake for 48 days and stayed there on weekends for 18. What does that look like? Some of those days, though, he worked on the roof. So that doesn't count as personal. Okay? It also doesn't count as rental either, but it doesn't count as personal. So he has 12 days personal and 48 days rented. All right? So this is primary rental because it was no more than 14 or 10%. Remember the greater of those two. All right, 12 days is less than 14. 10% would be a smaller number, but that doesn't apply because you get to use the greater. And so uh, this is primary rental and it has the rules for the primary rental scenario, which means you can have a loss. All right, but a limited amount. So there are two ways to allocate the costs or the expenses on a personal rental property or the primary rental property. Either time you allocate, you have to allocate either using the IRS method or the tax court method. So the IRS method is you take the ratio of the number of days of rental use to the total number of days used, period. One method for all expenses. The tax court method, which is usually more beneficial to taxpayers, is interest and taxes are allocated differently than the other expenses. Interest and taxes are allocated based on the number of days rental use to the number of days of the year. So not just the days that were used, but the entire year. The remaining expenses are allocated the same way as the IRS. So it only applies to interest on the mortgage on the property and the property taxes on the property. So if we have the following expenses, all right, rental property was income was 6,300. We used 22 days and 84 days. Okay, it's a personal rental property. You have to allocate the expenses. All right, so the IRS method, we would allocate 84 to 106 out of 106 multiplied by all of the expenses. All right, 34, 18, 79, 2, 1704. All right, now the depreciation was actually higher when we calculated it because it is a mix between rental and personal. We cannot have a loss, so we reduce the depreciation to make the net income zero. All right, so that's how the IRS method would work. Same allocation for all the expenses. The tax court method would use a different for the mortgage interest and property taxes, the 84 divided by 365. 84,365 for both of those, giving us a much smaller amount of mortgage interest and property taxes. Research, repairs and maintenance, same thing as before. Depreciation, same thing. This time, okay, we can take the entire, this is actually net income, shouldn't be in parentheses, this is a positive number. Depreciation is all deductible this year because we didn't deduct so much over here, and we're still under the 6,300. However, and where the benefit comes is the other part of this. The 4,300 minus the 990 goes on the Schedule A as an itemized deduction. So if you're itemizing, if you have other itemized deductions that are going to make that, then you get to deduct all of the mortgage interest and property taxes in one place or the other, either here on the Schedule E or over on the Schedule A. All right? It allows you to deduct all the depreciation and not be limited like it would be under the IRS method. That's why it's more advantageous. So your total deductions is higher under this as long as you're itemizing, as long as you have other itemized deductions. If you're using the standard deduction because your itemized deductions are lower and this isn't going to allow you to itemize it, then it's not going to be more beneficial to utilize the tax court method. Okay, so here's 75, another example, 75 rental use, 30 days personal use. Personal rental, the mix, okay, it's more than 15 days. If we use the IRS method, we take the entire, we can take all of them, add up the expenses, multiply by 75, divided by 105. Get $8,000, all right, and then you're up to the amount of your income on that property, because you can't have a loss. If you were using the tax court method, you would do a different allocation on the mortgage interest and property taxes, and that ratio would be the 75 or 365. So we've now looked at that 3 times to try to help remember, because it's a hard thing to remember. Allocating, putting the stuff that's rental on the Schedule E, the rest of it on the Schedule A for itemized deductions. All right, some perhaps less applicable areas in the tax law that are also reported on Schedule E: royalties. Result of a trade or business. If it's part of a trade or business, it should be on Schedule C. This is for intangible property, not real estate. This is somebody essentially paying you to use your idea. Intangible property like copyright or something like that. If it's part of you providing another service, it should be on the Schedule C. So there are several times situations it would be Schedule C. All right. So full-time author, that's his business. All right. Since royalty income from his book is really his business, that should be Schedule C, and then expenses for his writing would be deductible there as well. Okay. In this case, Catherine is a full-time dentist. This is not her business. She has an oil thing on her property, and while they don't pay your rental, they pay royalty for based on how much the oil comes out. Okay, this is not a trade or business, so this would be Schedule E. If there were expenses, they could deduct it against that income on Schedule E, just like a rental. All right. Our last topic is flow-through entities. These are businesses where we have ownership, but they don't pay taxes per se. They report income to the owners based on their ownership percentage, and then the individual owners have to report the income on their tax return. These are reported also on Schedule E, but on page 2 of Schedule E. So page 1 is the rental properties. These flow-through entities are on page 2. So these are eligible for the QBI deduction. That's an important thing to remember from back in Chapter 6. That's an important deduction. 20% of our business income. These qualify as business income. And that deduction, remember, is actually on the 1040. It's not on the Schedule C, and this is the reason why, because these also qualify, and so therefore it wouldn't work to put it on the Schedule C. So you get a Schedule K1, and that K1 will show you the income that is being reported for your ownership percentage. So the Schedule K is all the owners together. Your K1 shows you your part. So if you get a K1, you don't have to then multiply it by a percentage or figure out a part. That K1 tells you how much should be reported. It has already had your percentage applied to it. However, there may be more than one source of income from that business. It may have interest income, which would be reported on Schedule B. It may have capital gains that the business incurred, but now comes to the owner and needs to be reported on Schedule D, because that's where capital gains go. It may be that the LLC or the S corporation operates rental properties, and therefore the income that is reported on the K1 will be reported on your Schedule E, because it is a rental property. But typically the majority, or the business income, the primary result of the business, is going to be on page 2 of the Schedule E. All right, so limited partnerships, rental activities are considered passive activities, and we're going to talk about that in more detail in Chapter 13 this week. But you need to know that there are limitations there. They may have a loss that may be deductible, but may not. Okay, and so we finish up with the exception. Generally, losses from passive activities can only offset passive income. So you lose money on one rental property, you can use that to offset the income from another rental property, because those are both passive. All right, therefore they can offset each other. However, if your only loss is passive and you have regular income from a job or from a business, then it's very much limited what you can use that loss from a passive activity to offset other income. And that the exception, and very important exception, okay, $25,000 net loss, subject to AGI amount limitations and phase outs, which we will get to in our next podcast having to do with Chapter 13 for this week.